Hey there, my name is Michael Blanc, and if you're interested in getting started in apartment building investing, you are in the right place. In today's episode, I'm going to talk about the three crucial metrics you need to know about to determine if you're looking at a good deal or not. So you're interested in apartment building investing, which is great, and you're looking at a bunch of multifamily properties on LoopNet. Maybe even you're thinking of making an offer. It's kind of scary, but how do you know if the asking price is reasonable, or even more importantly, how do you know what you should offer? So there's really three main ratios for valuing commercial real estate. There are the capitalization rate or cap rate, the cash and cash return, and the debt service coverage ratio. So let's talk about each in return. I'll cover what they are, how to use them, what the value in a good deal. So I'm going to switch screens here and keep going. So the key indicator number one is the cap rate or capitalization rate. So what is that? So the capitalization rate is a way to value commercial property. And it's kind of like a multiplier of income. It applies to income. The more income a property makes, you apply this multiplier and out pops the fair market value for a building. So here's the formula for that. The cap rate is equal to NOI divided by value, which is the net operating income divided by the value. Now typically, the cap rate is provided by your broker or an appraiser, right? Someone who values commercial property. They say, oh, this is trading at a 7.5 cap, which means that investors are willing to have a 7.5% return on a property in that particular area. So the cap rate really is something that we're experts in the area. When they see a lot of deals that are being traded, what income they have and what price they has from that, they can deduce the cap rate. And they tend to be similar for similar buildings in a similar area, right? So that's the cap rate. Now, more importantly, the cap rate is normally used to determine value. Normally, what you want to determine is what the value is of a property, and you have the NOI and the cap rate from the broker. And in that particular case, this is how you determine the value of a building. So, for example, if the net hour income is $50,000 for a building, and the cap rate that's supplied by the broker is 8%. You divide 50,000 divided by 8%, and that's 625. And that's how very quickly you can determine the value of commercial property. So just be aware that the cap rate is slightly not as meaningful for a couple of reasons. Number one is you got to apply the cap rate to a real net operating income. So the net operating income is income minus expenses before the debt service. A lot of times when brokers apply the 8% cap rate that they just told you it's to and the expenses are low and the income is reported high. So as a result, the NOI is also high. So when you apply a cap rate to a NOI, that's how brokers arrive at an overpriced asset. So just be aware of that. Also, cap rates are not quite as useful if you're doing a value add deal, right? Because a value add deal has a lot of problems. Let's say it's got 30% vacancy. Well, you might be buying something at a really low cap rate, like a 4.5%, which you would otherwise never do. But because the upside is so large, you would gladly pay the 4.5 cap, meaning you're overpaying because the upside is there and the returns over the course of the project are very good. So just be cautious with cap rates. However, it is an important metric. And normally, you'd like to look for cap rates above 8%. If you can find a market where things are trading at or above an 8% cap rate, and then all you need is a little bit of upside, a little bit of value add, and the numbers can start to work. Now, the next key metric is the cash on cash return. The cash on cash return is really how much cash flow is left after all expenses, including debt service, divided by the total cash invested, right? So if I'm investing $100,000 into a deal and I'm getting $10,000 back of cash flow after all expenses are paid, I would have a 10% cash on cash return. Or in this case, if it's $20,000 and I have $200,000, then my cash on cash return is 10%. Now, is that a good return? Well, it depends. Again, if you're doing a value add deal, your first year cash on cash return might be very low. It might be 4%, right? Does that disqualify you from doing the deal? Maybe. It depends on what your criteria are. There's plenty of people who only want to do cash on cash return deals going in, right? If you're doing a more of a value add deal, you might consider a lower cash on cash. But what I would advise is that upon stabilization, so when you fixed whatever problem is going on, your projection should be a 12% cash on cash return or higher, all in. So before you have investors in a deal, and if you put investors in a deal, I'm really typically targeting 9% and above for the investors. Investors really like cash flow, and an asset once you fixed it upon stabilization should really produce 9 or 10% for the investors. The third key metric to pay attention to is the debt coverage ratio. Okay, and debt coverage ratio is something that the banks pay attention to. It's basically the net operating income, all the income before debt service. So it's NOI divided by the debt service. And it's simply a ratio to make the banks feel good that there's actually money to pay the mortgage. And what they're looking for typically is 1.25 or higher. So if I have $50,000 of NOI and my debt service is $40,000, I have a ratio of 1.3, and you're in the safe zone. If you're below that ratio, or 1.25, then you're going to have trouble qualifying for conventional financing. You'll likely need some kind of bridge loan or some construction loan or some kind of development loan with a lender who's comfortable lending on that. So those are the three main metrics that you need to be aware of to determine if something's a good deal or not, which is the cap rate, cash-on-cash return, and the debt service coverage ratio. Those are very important. Now, again, we're oversimplifying these things a little bit. I gave you some rules of thumb, but again, some of these things break down when you're doing value-add deals, right? So just be aware of that. But these are things, that's kind of your first filter on a deal is the cap rate at 8% or not, at least after stabilization? Is the cash return at 12% or better all in? And is the debt service coverage ratio at 1.25 or higher? So that's it for today's lesson on the three key metrics to help you analyze an apartment building deal. If you're interested in finding out more about apartment building investing, make sure you go to my website, themichaelblank.com. And especially if you're interested in analyzing deals, more information about that, there's an ebook I have all about the 10-minute offer and analyzing deals, and that's at themichaelblank.com/analyzer. So THE, Michael, BLANK /analyzer, and you get to the ebook download page for that one. All right, guys, appreciate it. Thanks for your time and attention. I'll catch you next time. Hey, thanks so much for sticking around to the end of the video. I want to leave you with 3 next things to do. I'll give you a quick tour of those, and I'll tell you how to do them. Step number 1 is to download my free ebook, The Secret to Raising Money to Buy Your First Apartment Building Deal. It is an awesome ebook full of tips for raising money and how to do that. So that's number 1. Number 2 is to subscribe to my YouTube channel because I put out new videos all the time, and I'd hate for you to miss it. And number 3 is to watch the next video in line. All right, so what you're going to do is you're going to click on the first thing, which is to download the ebook. That'll open up a new tab. The video will stop playing. You're going to get the ebook, and then go back to this video, and then click on number 2, right, which is to subscribe on the channel. That'll open a new tab, and then you can go back to the third one and just click on the next video in line. All right, so hope you find that helpful, and I'll see you in the next video.